Hey guys, how's it going? My name's Jeff. Today I want to tell you about my 5 favorite ETFs that I will be investing in 2023. For many of you who've been following my channel over the last year, you'll know that every month I invest in VTI, which is the Vanguard Total Stock Market ETF. And I'm going to continue investing in that because it just works and it's really simple. I really like the opportunity, the chance to beat the market. I feel as though trying something new, trying something different, it's like an experiment. If I can make this work, I might be able to beat the market's return by like 3%. You know, if it goes real well, I could beat the market by like 5%. I might also trail the market. You know, all this energy and effort, you know, we all like to think things are going to turn out in this awesome way, but in reality, sometimes, you know, by trying too hard and by getting too fancy, we wind up sabotaging what we could have accomplished with something super simple. We're going to put at least $200 into each of 5 ETFs. This is not financial advice. This is just information to help you to understand ETF. So here are my 5 ETFs for 2023. And I'm just going to start with the first one and I'm just going to go through them. The first ETF is AVUV, and that is the Avantis US. Hey Alexa, what is AVUV?
AVUV is an exchange-traded fund. Its full name is Avantis US Small-Cap Value ETF.
So the first ETF is AVUV, and that is the Avantis US Small Cap Value ETF. And what's interesting about this ETF is that it's actively managed. And you can see over here, it has a 0.25 expense ratio. And that's higher than most of the ETFs that I discuss, because most of the ETFs that I invest in fact, all of my ETFs are index ETFs. They track an index, so you don't have people trying to pick the stocks that make it into the portfolio. AVUV actually has 4 people on the investment portfolio team who pick which stocks make it into this ETF. And for AVUV, they have 2 criteria. One is, as the name suggests, they invest in value stocks. This is the US Small Cap Value ETF. And so these companies have to be selling at cheap prices relative to their earnings. And the other thing these managers screen for is profitable companies. So most of the stocks that make it into this portfolio, if not all of them, have to show that they are profitable. And that's something that many of the companies in the overall index, in the overall markets, like in VTI, a lot of those companies are not profitable. So what I like about AVUV is they're cheap stocks and they're profitable companies. And that is the #1 ETF in my portfolio. And so I'm going to be putting 20% of my money, because there are 5 different investments, 20% are going into this small cap ETF. The second ETF is VB, and that is the Vanguard Small Cap ETF. This is a blend ETF, meaning it not only invests in value, it also invests in growth stocks and everything in between. So this particular ETF invests in far more companies. As you can see, it invests in 1,501 different companies right there, whereas AVUV still invested in more than 700 stocks, but this one's got double the stocks, and it's got a much larger universe it invests in. And some of the companies are profitable and some may not be. But what I like about VB is it gives me exposure to all of these small cap stocks in the United States. And what you can see already in my portfolio is that through these first 2 ETFs, I'm putting 40% total, right? Because it's 20% into here and 20% into here. And that's going all into small caps. And so when I invest in VTI, the Vanguard Total Stock Market ETF, most of my money is going into large cap stocks, because that particular index, just like the Vanguard S&P 500, is heavily weighted towards large cap stocks. So with what I'm doing is I am betting more heavily on small cap stocks over the next year. If large cap or large cap growth outperform in the next year, then this portfolio probably won't do as well. But in order to try to get greater returns, you have to take certain risks. And my risk here is that I might not own a lot of large cap growth stocks. All right, ETF number 3 is VTV, which is the Vanguard Large Cap Value ETF. That invests in 343 different stocks, and the expense ratio is a super low 0.04%. And what I like about VTV is these companies are value companies. They are screened in such a way that the price for each of these stocks is pretty low compared to their earnings or compared to the profits that they earn. I'm unsure about a lot of things in the world, but I like the stocks in this particular ETF. For example, the number 1 holding is Berkshire Hathaway. It holds a lot of energy companies like ExxonMobil and Chevron, as well as pharmaceutical companies like Eli Lilly and Pfizer. I like holding these kind of companies. I like this particular approach to investing, which is value investing, and I think that this ETF accomplishes the goal of getting me invested in large cap value stocks, and it does it at a very low cost. So that's my third ETF. Number 4 is VHT, and that is the Vanguard Healthcare ETF. And you can see that invests in 423 stocks, and it charges 0.10 expense ratio. So what I like about this is I've always loved investing in healthcare stocks, but it's very hard to know which particular stocks are going to excel. But I think that in any environment, really, I love holding stocks in pharmaceutical companies, medical device manufacturers, hospitals, health insurance companies, and this particular ETF focuses on exactly those kinds of companies. So without me having to choose specific pharmaceutical companies or device manufacturers, I just get them in this ETF, and that way I'm assured that no matter how good or bad my stock picking in this sector would be, I don't have to worry about it. VHT gives me great exposure to that sector. And finally, last ETF in this portfolio, it's VGT. And VGT is the Vanguard Information Technology ETF. You can see it holds 375 different stocks. And these are basically tech stocks. Now, this is obviously going to hold stocks in companies like Microsoft, like Apple, MasterCard, and Nvidia. It doesn't have some companies that might be considered tech companies. For example, Amazon's not in it because Vanguard categorizes Amazon as a consumer discretionary, which is a retail stock, so it doesn't make it into this particular ETF. But I like investing in these tech stocks. I think that over the next 5 to 10 years, it's going to be a good sector to be invested in. And I particularly like it now, going into 2023. A lot of these stocks are down 30, 40, 50% or more. So I like investing in them, especially because their prices have been crushed so much. I know a lot of people, when they see these growth stocks or tech stocks down, they kind of want to stay away because there's a lot of fear about what's going to happen in the tech sector in the next year. But for me, this is not anything to be afraid of. Personally, this is my own investing approach. So I have no caution when it comes to buying things when they're really cheap. In fact, I look for opportunities to buy quality companies when they're cheap. That's what value investing is really about at the heart. So VGT makes it into my portfolio. Now to just take a kind of overview, all right, I'm going to invest every month on the first of the month, as long as the market's open on the first. And I'm going to invest at least $200 into each of these. Now, for some of these, it might mean buying more than one share. For example, AVUV.
AVUV is an exchange-traded fund. Its most recent price is $73.27 per share.
All right, so it's about $73 per share. So if I want to invest at least $200 in AVUV, then I'm going to have to buy 3 shares of that particular. For example, hey Alexa, what is VGT?
VGT is an exchange-traded fund. Its most recent price is $311 per share.
All right, so that's $311. And because I'm not buying fractions of a share, then to buy at least $200 worth, I'm going to actually buy 1 share. So I'm going to spend, for example, if I did it today, $311, which is a lot more than I would be investing in AVUV, which worked out to just over $200. So anyways, that's a reality of this investment portfolio. I will be investing more into, for example, VGT when I make my first investment. And I expect that I will probably be investing more than $1,000 each month because of these slight incremental overages. So with this particular approach, if I were to get a 7% return, okay, my return after 10 years would be about $243,000. But if I just got 3% more than that, I would get $281,000. So I'd be getting almost $40,000 more in return just by earning a 3% greater return. And if I trailed the 7% by 3%, so if I only got 4%, then my return would be $211,000. So again, that to me wouldn't be the worst punishment for a failed mistake. It would just mean my returns were lower than hoped, but sometimes this just happens with investing. And let's look at beating the market by 5%. If I were to invest the way I'm doing it, okay, which is I'm just assuming I'm going to be putting in about $1,450 each month. By just getting 7%, I'd get the $243,000. But if I beat the market by 5%, that goes up to almost $310,000, okay? If I trailed the market by 5%, then my return would be -5, so it would be 7 minus 5. So the 2% return would be $192,000. So again, it's not as great a return as I wanted, but I guess the point here is I'm willing to settle for a return that might lag the index fund or the overall market for the chance of beating the market and getting a much greater return. $309,000 or $310,000 is about $70,000 more than the 7% return, and that is a lot of money. It's kind of what drives it, is just, and in the current environment, in the current economy, I find it really hard to pick stocks. So what I do is choose these ETFs, and I realize it's not a perfect solution, but it's one I can live with, and I find it far less risky to invest in any one of these 5 ETFs, because as you can see, the diversification is insane. 700 stocks, 704 in AVUV, 1,501 in VB, 343 in VTV, 423 in VHT, and 375 in VGT. And you know, if you just take a look at those stocks right there, rather if you take a look at those ETFs, you'll see that the total is 3,346 stocks. So that's far greater diversification than you'd even get in the S&P 500 ETF. So I'm not worried about any one stock in this particular portfolio. And what I like about this is that even though I still have investments in large cap stocks, mainly through either investing in the stocks or holding shares of, say, the total stock market, I like the idea that this is different from those particular indexes. And this is not what everybody else is investing in. This is kind of a contrarian play on the stock market in the next year. And it's one that's sure to teach me some valuable lessons, hopefully on the good side, but maybe there'll be mistakes that I can learn from in the future. If you have any questions, put them in the comment section. If you like this video, give it a thumbs up. That way other people out there in YouTube land will get a heads up about this ETF video. And if you have not yet subscribed, what are you waiting for? Hit the little subscribe button and you'll get a heads up whenever I make a new video. Thank you so much for joining, and I will see you in the next video.